Today was Kevin Warsh's first meeting as the new chair of the Federal Reserve, and it didn't go the way the market was hoping. Stocks had one of their worst Fed days in decades. Tesla fell with them, and the real surprise was what the Fed signaled comes next. Not a rate cut, but possibly a rate hike. We've also got a record number of Cybercabs piling up at Giga Texas. A Dutch regulator firing back hard at a critical report on Tesla's self-driving. A tale of two states on robotaxi rules, and more. This is the Tesla Brief, after the close on June 17th. Welcome to the show. A quick look at the stock. Tesla closed down 1.6% at $396, while the Nasdaq fell 1.3%, and the S&P 500 dropped 1.2%. So Tesla slid a little more than the market. But this was a broad sell-off, not a Tesla story, and it all started with the Fed. So let's start there, because it's the reason almost everything on the screen was red today. On the surface, this should have been a quiet meeting. The Fed left interest rates exactly where they were, in a range of 3.5% to 3.75%, which is precisely what everyone expected. But it was Warsh's first meeting in charge, and the tone underneath that decision shifted hard. That's what spooked the market. Here's what changed. 4 times a year, the Fed publishes a chart showing where each of its officials expects rates to go. On the new chart, 9 of the 18 officials now expect at least one rate hike before the end of this year. Their middle-of-the-road forecast for where rates land at the end of 2026 jumped to 3.75%, up from about 3.4% back in March. In plain terms, the group that was leaning toward cutting rates is now leaning the other way. The written statement told the same story. The Fed trimmed it from 341 words down to just 130, and in the cutting, it removed the language that had hinted at future rate cuts. What's left leans hard on fighting inflation rather than protecting jobs. And Warsh himself appears to have skipped putting his own dot on that forecast chart entirely. A quiet break from how every chair has done it for years. The interpretation is that he wants to step back from promising the market anything in advance. Put it together, and traders are now pricing in a real chance that the Fed's next move is up, not down, possibly as soon as September. Now, why does a Fed meeting matter so much for Tesla specifically? Because Tesla's value leans heavily on profits expected years out. Robotaxi, Optimus, self-driving. And those distant profits are worth more today when money is cheap and expected to get cheaper. The Fed just signaled the opposite. And a stock like Tesla, well, it's a bet on the future. And the Fed just changed how investors are betting on that future, which swings harder than the market in both directions. Tends to feel that shift more than most. That's why a 1.2% drop in the S&P showed up as a 1.6% drop in Tesla. Jeffrey Gundlach, the bond manager at DoubleLine, summed up the new mood in a single line. Warsh, he said, is not going to be the easy money chairman many hoped for. Gary Black, who runs the Future Fund and is one of the more closely watched independent voices on Tesla, read the meeting the same way, leaning toward keeping interest rates higher, he called it, pointing to that jump in the rate forecast, the slash statement, and Warsh stepping away from the chart. But here's the part worth holding on to. A day like this, a clear shift toward higher for longer rates, is exactly the kind of event that would normally push an active manager to change his position. Black didn't. He restated where he stands on Tesla itself, and it's unchanged. He remains, in his words, cautious on Tesla amid declining earnings forecasts, rising autonomous competition, and an extended PE relative to future growth potential. So the macro got more hawkish, and his read on the stock stayed exactly where it was. Now to the news that's actually about Tesla's future, and there's a clear pattern building around the Cybercab. A drone overflight of Giga Texas today counted 120 Cybercabs sitting in the outbound lot, a new record, beating the 102 count from just 2 days ago. The same observer reports watching what looked like an autonomously driven Cybercab, with no steering wheel, arrive at the line and reverse smoothly into a parking spot on its own. And for the first time, the Cybercabs are being staged alongside regular vehicles in the normal shipping lots, which he reads as a sign the production logistics are shifting toward real volume. Beyond the factory, a Cybercab was reportedly spotted on a public street in Los Angeles, and another turned up in New Zealand, where it's currently winter, which makes it a plausible cold weather testing location. None of these on its own is the headline. The pattern is the point. The Cybercab just got its certificate of conformity from the EPA earlier this week, which means it's legally cleared to be sold. Build counts are climbing week over week, Real-world footage is showing up on 3 continents. And the gap between Cybercab as a concept and Cybercab as a real fleet vehicle is closing in ways you can actually measure. And here's where it gets interesting. Because on the very same day, you can watch the map of where robotaxis can actually scale being drawn in real time. And it cuts both ways. In Texas, Mark Williams, the executive director of the state's Department of Transportation, sat in the production version of the Cybercab at a state innovation event and went out of his way to talk about it afterward. He called it a tangible example of how quickly our transportation system is evolving, and described the cabin like this: no steering wheel, no accelerator, no brake, only a single touchscreen monitor. That matters, because Texas is where Tesla's robotaxis already run unsupervised today. Austin, Dallas, Houston, and San Antonio. When the state's top transportation official is publicly enthusiastic, rather than cautious, that's the kind of quiet tailwind that doesn't show up in any filing, but does show up in how fast the fleet can grow. Now flip to New Jersey. Tesla escalated a lobbying fight there today over a pair of bills it says don't just regulate robotaxis, but in its words, specifically ban Tesla from the New Jersey market. Tesla is calling the legislation anti-competitive favoritism, rather than a genuine safety measure. It points out that the state had 578 traffic deaths last year, and that more than 94% of serious crashes come down to human error, impairment, distraction, fatigue. The new edge tonight is that Tesla is now openly framing this as competitor-driven legislation, a sharper accusation that hints at who it thinks wrote the language. So on a single day, celebrated by the transportation chief in one state, accusing another of trying to legislate it out of existence. That's the rollout, state by state, happening right in front of us. There's also a notable development out of Europe on Tesla's self-driving, and it's a regulator answering a journalist in public. Earlier this week, Reuters ran a story arguing that Tesla had leaned on a disputed safety figure to lobby European regulators into approving its supervised, full self-driving. Today, the Dutch Road Authority, the RDW, the agency that actually granted that approval, pushed back in detail, and the numbers it put on the table are specific. The RDW says it ran more than 3,000 hours of its own testing and over 1,000 separate test runs on public roads and tracks. Its analysis was built on data from 1.8 million kilometers of European full self-driving. Since approval was granted, it says nearly 40,000 Teslas running the system in the Netherlands have together driven about 24 million kilometers. In its words, with no relevant incidents reported. The message is essentially a rebuttal. We didn't rely on Tesla's numbers, we tested it ourselves for 18 months, and we've actually tightened the requirements. Tesla now has to report to us monthly instead of once a year. Tesla's head of autopilot, Ashok Eluswamy, replied to the news, calling the process extremely rigorous. It's worth flagging because the original story raised a real question, and the regulator's own answer cuts the other way. On the competition front, there's a number out of China worth paying attention to. BYD launched its new flagship electric SUV, the Great Tang, at around $35,500. And it pulled in more than 150,000 pre-orders, the highest BYD has ever recorded for a single vehicle. The car is being sold on nearly 600 miles of range and a 5-minute fast charge, both stretching what BYD has claimed before. Why Tesla investors should care? This SUV sits in exactly the size and price bracket where Tesla competes in China, the Model Y today, and any cheaper model down the road. And those pre-orders are a real data point. Chinese buyers are voting with deposits. Pair it with a profit warning from BMW earlier today, which specifically blamed a slowdown in China, and the picture sharpens. Chinese consumers aren't pulling back from cars across the board, they're being more selective about which cars. The question that raises for Tesla is whether its next round of China numbers holds up against that kind of homegrown launch energy. A couple of quicker items on the swirl around Tesla's place in Elon Musk's wider empire. The prediction market platform Kalshi now puts the odds of a Tesla-SpaceX merger within the next year at 45%. That's not a forecast that it'll happen. It's a measure of how seriously the conversation is taking it. And the discussion among Tesla investors has moved on from whether a deal could happen to how the math would actually work. People are walking through fairness opinions for each company, and a fixed swap of shares that owners would vote on, possibly as soon as next month. Here's the piece that conversation keeps skipping. In any plausible version of that deal, Tesla shareholders would end up owning a smaller piece of a much larger combined company. So the real question isn't whether a merger sounds good in the abstract, it's whether that smaller slice of the bigger thing is worth more than the bigger slice of just Tesla. Nobody has shown that math. because the inputs to do it honestly don't really exist yet. The discourse has run ahead of the data. And in the background, the AI keeps advancing, just not inside Tesla. Elon posted a 2-minute AI-generated trailer for a reimagined Odyssey, made by xAI's Grok, and added 3 words: full movies by the end of this year. The trailer's genuinely impressive. But every visible leap like that pushes more attention and more capital toward valuing the Musk companies that aren't Tesla first, which is exactly what feeds that question of who owns what when the dust settles. One quick one on the engineering side. A newly granted Tesla patent describes an active suspension system built to deal with potholes. When the car senses a pothole coming, it can actively pull the wheel up so the body doesn't drop into the hole. A patent isn't a product, so don't expect this tomorrow. But ride quality is one of the few car-level criticisms that's stuck to Tesla through every model, and it's worth knowing the company appears to be engineering directly at it. So what to watch from here? Tomorrow brings weekly jobless claims, which are lightly watched. Friday, US markets are closed for the Juneteenth holiday, so there's no episode. Then on Monday, the weekly China insurance registration data lands, and this week, that's the number to hold on to. It'll be the first real read on Tesla's demand in China, since BYD's Great Tang launch pulled in those 150,000 pre-orders. If that launch is dragging buyers away from Tesla, Monday is where we'd get the first hint. And if it isn't, that tells us something too. It would mean China's EV market is expanding, rather than just rotating from one brand to another. The bigger item on the calendar sits 2 weeks out: Tesla's second quarter delivery numbers, expected in the first business days of July. That's the Tesla brief for today. If it's been useful, please subscribe. Thanks for joining us, and we'll see you in the next episode.